Okay, you guys, we're now going to take a look at corporate bonds. Now, corporate bonds are just another way that corporations have of financing operations. They really have three primary ways. They could take out a traditional loan like you and I would do, maybe at the bank or from another lender. They could issue equity securities, which would be selling shares of stock in the business, or they could issue corporate bonds. And corporate bonds are just a form of borrowing, but instead of borrowing from a lending institution, the corporation is borrowing from the investing public. And when they issue those bonds, they promise to do two things: pay interest periodically, and then repay the face amount at the end of the bond term. So let's look through a few notes here on some basics with corporate bonds. Okay, in reading about bonds, we find that bonds are simply, like I said, debt instruments for the company. They're sold in small quantities to investors, usually broken up into $1,000 increments. And granted, issuing them is much more complicated than that statement, but the basic concept is there. The company is borrowing money, but rather from a financial institution, it's coming from individual investors. They borrow the money for a set amount of time, and when the time period ends, they repay the face amount. Of course, we'll pay some interest along the way, and that's usually paid every 6 months. All right, so let's look at some basic information we'll need when accounting for bonds. When looking at bonds, there are a few things that should be identified. Okay, we've got the face value. I typically use, and you'll notice I can't seem to get away from it in these lectures, but I typically say face amount rather than face value, but again, it means the same thing. That's the amount of the bonds issued in total. Also, the amount that must be repaid at the end of the bond term. The face amount would be recorded in the liability account, bonds payable, when the bonds are issued. The stated rate or coupon rate is the interest that will be paid periodically over the life. A lot of times that's every 6 months. The effective or market rate is the rate of return the bond must yield to the investors, or it's the rate of return that corporations with a similar credit rating would pay on bonds that they issue. Now, hopefully those two rates are the same on the day the bonds are issued. That's the goal, right? But a lot of times that market rate will move between when the bonds are drawn up and when they're actually issued. We'll get into that in the next lecture, but the bonds will be structured to yield that market rate even if it's not equal to the stated rate. And again, we'll get more into that later. The terms is how long we are borrowing the funds and how often we'll pay out the interest on the bond. Again, that's usually every 6 months. And then the issue price is the amount of cash the issuing corporation will receive on the day the bonds are issued. So let's take a look at an example here. Mac Company issues $750,000 of 8% 5-year bonds on June 30th, 2024. The bonds pay interest semi-annually on June 30th and December 31st. At the time of issuance, the effective rate for the bonds was 8%. So notice here, the state. Let's break down what all the terms are. Okay, the face value is the $750,000. The stated rate, that's the rate of interest that will be paid on the bonds to the bondholders. It's 8% for a year, but since they're paying interest semi-annually, that'd be 4% every 6 months. And the market rate on the day the bonds were issued, the market or effective rate, was also 8%. If the two rates are equal, you guys, these bonds will be issued at their face amount. Now, the term is 5 years with semi-annual interest payments. So that means what? We have 10 interest payment periods. And again, the issue price would equal the face amount because these two rates are equal. And we'll get into in the next lecture how we'd handle it if those rates were not equal. But I don't want to get too far ahead of ourselves here. Let's go ahead and look at how this one would be handled. Okay, when Mac Company sells these bonds to the investing public, they're going to receive this issue price of $750,000. So there we would debit cash, $750,000. That's cash coming in from financing activities. And we're going to credit bonds payable for $750,000. Now that increases assets and increases liabilities. Okay. Now they were issued on June 30th, 2024. So the next date associated with the bonds would be the interest payment on December 31st. Well, to get that amount, we'll say a $750,000 face value. I'm going to try to make myself use face value instead of face amount. Anyway, we'll multiply that times half the stated rate. Now our stated rate, again, was 8% for a year, but that'd be 4% every 6 months. So 0.04. So the semi-annual interest due on these bonds would just be $750,000 times 4%. Or $30,000. Let's make that look like the other one. There we go. So that's how much interest would be paid every 6 months. So that goes to our next journal entry. On December 31, when interest is paid, we debit interest expense for that $30,000. Now remember, interest is always recorded as an operating activity. And we paid it, so we'd credit cash. All right, so our expenses there increased by $30,000, causing net income and stockholders' equity to decrease by $30,000. And our asset cash also decreased by $30,000. Then when the next interest payment date rolls around, June 30th, 2025, I'm just going to do the same thing again. That $30,000 is due in interest every 6 months, you guys. Notice this entry on June 30th, 2025 looks just like the one on December 31st, 2024. The only difference is the date. And it would continue that way every 6 months. Then when the bonds mature, the issuing corporation would pay out cash of $750,000 to the bondholders, and they would wipe out the bonds payable off the books. So when they were paid off, bonds payable would be debited and cash credited. All right, so now let's go to another example here. Same example with a different twist. They issue the bonds on March 1st, 2024. The bonds pay interest semi-annually on September 1st and March 1st. Well, this time our interest payment period is going to carry over the financial statement date. So that'll end up requiring an adjusting journal entry, will really be our only difference here. So let's make the journal entries for these bonds. There's really no calculations for us to do this time because it's the same as the last example. Let's journalize the entries for this bond issue on March 1st. That should say 2024. All right, we would debit cash for $750,000 and credit bonds payable for $750,000. Assets increased, as did liabilities, and that's cash coming in from a financing activity. Then the first interest payment date would be September 1st. And we debit interest expense and credit cash there for our 30 grand again. Remember, interest is an operating activity. The expense increased, causing net income and stockholders' equity to decrease, and assets decreased as well through cash, right? All right, now what's going to happen? Interest is going to build up on these bonds in September, October, November, and December. So 4 months worth of interest will build up by the financial statement date year end. So if we want to know interest accrued on bonds payable by 12/31/24, what do? Well, we'll take our 30,000 total interest for 6 months, and how many months of it have built up from the last interest payment date to the end of the year. Well, let's go back and look to make sure. The last interest payment was made on September 1st. So how many months passed off by December 31st? Well, you got September, October, November, and December. So 4 months. So times 4 divided by 12 gives us $10,000 of interest built up on the bonds by year end. So that will be the amount for our adjusting journal entry. We debit interest expense. Now, why did they have 20 here, and how did I get 10? Okay, so I said the months of September, October, November, and December. So 4 months. I know what I did wrong. Did you catch it? I was used to our notes payable. I did 4 out of 12 months. It's actually 4 out of our 6 month interest, 6 months in the interest payment period. So that's why it's 20 grand rather than 10. So what are we doing here? Again, we're just going to say the 30 grand interest for 6 months times the 4 months that passed divided by the 6 months in the interest payment period. So that's $20,000. That's our debit here to interest expense in the adjusting journal entry. It's going to be a credit to interest payable. Let's get this all on one page here. No cash was involved. Hope that makes sense, you guys. It's what, 4/6 or what, 2/3 of the interest would have accrued by the end of the year. 20 grand, of course, is 2/3 of 30 grand. Cash was not affected. Expenses increased by 20,000, causing net income and stockholders' equity to decrease by 20,000. And then our liabilities increased by 20,000. That's the interest payable. All right, then when the next payment is made on March 1st, 2025, we're only going to debit interest expense for the 10 grand that built up in January and February of 2025. That's the other 10,000 out of the 30. That'll be debited to interest expense. Now that gets it on the income statement in the proper period, as did the adjusting entry at the end of the prior year. This interest built up in 2024, so we got it on 2024's income statement. This interest, though, accrued or built up in 2025, so this will get it on 2025's income statement. Now the interest payment has been made, so this liability to interest payable gets wiped out. It's debited, And then the credit would, for 30 grand would of course be to cash when the payment was made. So the only difference in this one and the first one was our interest payment period carried over a financial statement date. So we had to record interest earned by the financial statement date as expense in year one. Then the remainder of the interest expense would be recorded in the second year. Okay. I believe that's got us there. Now in the next video, just to give you something to look forward to, we're going to see how we handle it when the two rates are not equal. Okay. Thanks, and as always, please be in touch if you have questions.